partner, Barry Ritholtz, has interviewed some of the largest asset managers, hedge fund managers, RIA founders, you name it, he's had them all. This is the first time that Barry will be speaking with, in my opinion, one of the most successful people who's ever served clients as an advisor in the history of our industry. I'm really excited for this session personally because I think I have a lot to learn. He doesn't need a lot of introduction in the way of assets under management, offices, employees. You all know he's one of the largest RIAs in America. The founder and I believe president and CEO, he'll correct me, of Creative Planning, Peter Mallouk. Barry Ritholtz, Peter Mallouk, come on up on stage.
Before we get started, I just want to go over some of the numbers because they are pretty impressive. Peter Mallouk of Creative Planning, the only person on Worth's list of 100 most powerful people in finance who actually advises clients, the only person to be listed #1 on Barron's top independent advisors 3 consecutive years. Creative Planning now manages $42 billion in assets for 96,000 clients in all 50 states, and you have never spoken at a financial conference.
That's right.
Ever before this. Is that correct?
That's a true statement, yeah.
So that's a little crazy. Let's start with the early days of your career. You come out of the University of Kansas with a JD MBA.
Yep.
What do you start doing for a career?
So I start advising doctors on their practices. Mm-hmm. One of the doctors starts asking me to advise him on his personal stuff. I do an okay job. He starts sending me to other doctors. My dad's a doctor. He starts telling doctors. Somebody asks me to do their legal work. I become an estate attorney. This doesn't sound very planned out, does it?
No, not at all.
So then I become an estate attorney. I'm like, hey, this is great. Why am I doing all of this, trying to figure out practice management, financial planning? Everybody's practice is different. So I start doing wills and trusts. An advisor goes from me doing one of his clients to having me do the legal work for 120 of them. Next thing I know, I'm dealing with 100 advisors. One of those advisors has his team leave, planning team, asks me to take over the planning build a team to take over the planning for his team. It was a $30 million firm. I looked at it, I said, I don't need a team, I can do this myself, right? So I started doing that and the legal work for other advisors, and then eventually that led to trying to put all this together in one place, Creative Planning.
So you joined Creative Planning, was it 98?
So 98, I was running my law practice, and I took over their $30 million book, and I took over Creative Planning in 04.
So now the last bit of numbers I'm going to focus on. Yeah. At the time in 2004, the firm had less than $100 million.
That's right.
Now it's $42 billion,
yep.
Mostly organically with no acquisitions.
Yeah.
What did you do to turbocharge growth from essentially a solo practice to a giant RIA?
Well, I think in the beginning what is very common today was not very common in 2004. So if you think about when we would give away a financial plan to everybody because we felt we couldn't manage the money without a plan. And everything you read said this was idiotic, right? It was like, it's not, if you don't charge somebody, it's not valuable and they won't listen to it. And you know, that's how can you advise somebody on their money without a plan was our attitude. And so we did it. At the time, that was a little different. We were passive in 04 when you had to explain what an ETF was, and Bogle was talking about how ETFs were bad. I mean, back right. Then. So, and the typical person you met was in a mutual fund. So if we were doing legal and tax in-house, we were doing financial planning without a separate fee, we weren't using models, we had models that were our baseline, but we were working around positions and outside real estate. That was different then. And then we just had a process, we were very process oriented. Like, how do we take somebody through a process that is not, where we can't screw it up, right? Where we're not going to make the accidental trade error, where we're not going to miss trust funding or something like that. I think we were pretty good at that. And then I think the real kicker is I got really, really lucky with what happened with the markets in 08, 09. We did really well through that. That really helped. We went into that at 500 million. We came out of that at a little over 2 billion. That was really kind of the coming of age of Creative, was that 18-month period. And our first few hires were amazing, not because I knew what I was doing, but because incredibly lucky. I learned later how lucky I was. But really, we're at a tech, we happen to be doing this Masters of Business at a tech conference. And tech is not what makes a business great. People are what makes a business great. And this business in particular, it's people. So and everyone says that, but then they commoditize their people. They think, oh, I can have a financial planner is all the same, a lawyer is all the same, a CPA. Very, very different.
Are you still interviewing every person the firm hires?
I still do, but I mean, that's in the press a lot, and it's true. But they go through a whole process before they get to me, right? So somebody's screening the resumes, and someone in our talent acquisition team's interviewing. They're being interviewed by the head of wealth and planning. I'm meeting them last, and it's kind of the "would I put my mom in front of them" test, and less "do you know what you're doing." By the time they get to me, we're pretty sure they know what they're doing.
So you have a broad range of clients, and they seem to be broken up into 3 groups, and I want to get a better understanding of these 3 groups: emerging wealth, private wealth, and ultra affluent.
Right.
What do those different tiers mean, and how do the services Creative offers them vary?
So when we started, it was basically, I mean, if somebody signed up with 80 grand, we were going
Sold.
out to dinner to celebrate. I mean, we were really, I mean, that was not that long ago. In 08, 09, if somebody signed up with $1 million, we stopped and partied. I mean, we were always good at celebrating every step of the way. I think that's a big part of things. But private wealth clients are our main clients, the 500,000 to 10 million. That's of the 42, 43 billion that we manage, it's probably 35 of it. Emerging wealth, we started 3 years ago, where it's people have less than 500,000. It started off as an offshoot of all of our clients' family members, and it just became a, hey, if we'll give you a service. We found a way to deliver, not the exact same thing, but close enough. And that's maybe 900 million, but it's now 4,000 clients. It's a huge number of clients. And then the balance, which is pretty significant, I'm not going to do the math right, but 6 or 7 billion is the ultra affluent practice. So people who might have 10 million or 100 million or 300 million. When we got to about 25 billion in assets, that became a whole new thing for us. That was just a couple years ago.
25 million, 25 billion?
Billion. Right. Where, I used to meet some of those people when we got to about 5 or 10 billion, but they still, you're competing with JP Morgan, Goldman Sachs, instead of the other places. And they were a little uncomfortable with our size. And I think when we got over 25 billion, they were more open-minded. They call us, they get referred to us, and now we win those cases. So it's a little bit of, in this business, I think I believe in cumulative advantage, which is the concept that the person in front, they've got an edge to stay in front. Like you really have that advantage, like the Patriots, right? They're more likely to get a player who's willing to come in under the salary cap or something like that because they want a Super Bowl ring. I think the bigger you are, competitors will say, oh, they're too big, but the reality is the client wants that comfort. They're scared shitless, right? In this word, they have a reason to be. So they feel like a bigger firm has more to lose, better processes, better people, more institutionalized. So we found it easier to compete in that arena now.
So there's a quote of yours that I'm intrigued by and I want you to explain. Quote, 2 things are driving industry consolidation. Regulations and technology.
Right.
Explain that.
So I think it's that on the one hand and valuations on the other. So everybody in this room that's got a firm that manages 300 million or more is probably getting called every month, right? That somebody wants to buy their firm.
Is everyone getting called?
Yeah.
Oh, some hands go up.
Raise your hand if you've been called by a consolidator or a private
Raise your hand if you want Peter to buy you.
Right. Joe Duran will be here tomorrow night. He'll knock everybody down. I think that what you have is valuations have gotten crazy. And on the one hand, on the other hand, you get to that level where you're at 500 million, you never thought you'd be able to sell your firm for what you can sell it for. And on the other hand, when you start to get to $1 billion, you have to reinvest in technology. We're covering today, a lot of compliance, things like that. And so you really have to make this decision, am I willing to go backwards for a few years to go forward? Now, a lot of people, the answer is yes, but some people are no. And those people then fall into lifestyle practices, which
meaning $50, $100 million, and they're making a nice living.
Or even they stop at 500 and they've got a small team and you make a great living, right? So you fall into lifestyle practice, and look, I'm not convinced those people don't have it figured out, right? So there's something to be said for that. Or you fall into the camp of going, wow, valuations are really high. What are they going to be like in the future? Are they going to be like this? I don't think so. And I think a lot of people don't think so.
So you've talked about this before. I've read some of the things you've said about valuations.
Right.
Why have, another quote, it's the hottest it's ever been and possibly ever will be. It's just bonkers right now.
Yeah.
Why have valuations gone so crazy in the RIA space?
I think what happened is it used to be you'd have $1 billion firm buys a $300 million firm, or a $5 million firm buys a $500 million firm. And so valuations were reasonable. It was what could you guys, if you wanted to buy a firm for, what would you pay for a $300 million firm?
What are you asking?
So private equity steps in and goes, hey, first of all, there's now 8,000 private equity funds.
Right.
There's more private equity funds than publicly traded stocks. People are scared of the stock market, so they think private equity is safe, which is obviously
No mark to market,
illogical,
so
right?
they never see a
Never have to
drawdown.
pay attention to what happened in December of 18. So all this money is flooding PE. I also think you have all these institutions, endowments that they're going, hey, we look at the last 20 years, hedge funds didn't work, private equity worked, I'm moving my money from hedge funds to private equity. So you have all this money in private equity, all these private equity managers, what do they have to do to make money? They have to deploy, right? They can't just sit on the sideline, they have to deploy. What do they like? They found out they like recurring revenue. And they found out that the RIA space is starting to develop a little bit of scale. So you have a little bit of scale, ripe for consolidation, recurring revenue, built-in inflation hedge because it's tied to the stock market,
Right.
and fragmented. So they come into this space, and how do they buy? Well, if you look at how you buy a home, if interest rates are 7%, your home is not worth what it's worth today, right? If interest rates drop to 1%, your home will be worth more.
The last panel said that's about to happen.
All right,
so-
well, great. So yeah, exactly, or you might be negative rates. But basically, the buyer plugs into a spreadsheet, and this is really how it's done, the actual interest rate they're going to have to pay to buy your company, because private equity is not paying cash. Private equities, if your earnings are $1 million, they're going to go borrow all of the $1 million to buy you out, and they're going to pay you a multiple of your earnings, and they're going to borrow all the money to do that, because that's the only way they can really get their double-digit rate of return.
So it's scale, borrowed
They
money,
need the leverage.
Yeah.
So now they come in and they buy a platform, and then they buy other firms, and they tuck it under there. But they're coming in, they can pay 6, 7, 8, 10 times earnings because they're using borrowed money and hoping that over 5 years they can buy another couple firms underneath it and sell the whole thing to the next person. Well, that's worked out ever since private equity got in the space, because it's been the last 5 years. Market's gone nothing but up. So
Rates have gone down. It's made borrowing really cheap.
So ton of money, cheap borrowing, recurring revenue. What could ruin it? A recession, a prolonged a pullback in the stock market, a PE firm getting burned with one of these deals, which hasn't happened yet. When that happens, you might see valuations change. But I think some people that own RAs are going, wait a second, I tried to sell this. I was looking at selling this 5 years ago, and today it's worth double. My assets haven't gone up. Some of them are saying, maybe I should look around. I think that's why you're seeing so many transactions now.
So the rule of thumb I always used to hear was 2 times revenues.
Yeah.
Is that still in effect? Has that number gone up?
That's completely out the window now. Because
Really?
one thing PE has done is it's brought some sophistication to this. So it's not like one RA borrowing another one. Even when an RA is buying another one, they're competing with private equity, which is driving the prices. So it's all about earnings. You forget about what the revenue line is. They're basically going to look at what are you earning and what are you going to be earning after you go into their deal. So if you're like an RIA and some of these lifestyle practices, $500 million and it's 2 people, you're going to get discounted by a buyer because they're going to actually, their margin's going to compress after they buy your practice, right? They're going to have to institutionalize you a little bit with compliance and HR, all the stuff you're not bothering with. They're not going to make as much money as you did. Now, a practice that's run efficiently, if it's $500 million, it's got 15 people, PE is going to come in and go, well, we're going to make that 8 people one way or another. We're going to realize some synergies here, and they'll pay you that higher number because they can make up the difference later. So how you run your practice has a lot to do with the valuation as well.
So you just made your first acquisition of
Right.
$500 million firms.
Yeah.
I have a million questions about that. Why? You were
Yeah.
doing so well organically,
Right.
and what do you look for in an acquisition?
So I think this year without the acquisition should wind up being creative planning's best year. But I think that the way I've looked at it is I'm not a big fan of the Franken firms. You got a firm and it's like 60 other firms put together. And a lot of the times they're not even using the same technology. They don't even bother to integrate the billing or change the carpet in the offices to match the colors. I think even the ones that try, they're usually flipped so quickly from PE firm to PE firm that it doesn't really happen. I think if you look at the 10 largest firms, most of them are owned majority by private equity. So I've felt like I didn't want to do any acquisitions because I feel like to build a culture, you have to have the strong tree trunk, right? And so I wanted to build a culture. This is the process we use, this technology we use, this is the type of people that we hire and that we keep. This is what we do for our clients. This is, to me, the essence of a firm is its culture. Now, this doesn't matter in the transactional world, but if you're in it for the long run, I'm clinging to my 40s, I want to be doing this for a long time. I have to like the people I work with. I have to believe in the people that are going to be sitting across the table from them. So it's not all about money. it's a nice for-profit business, but it's not all about that. So you have to have a very strong culture, have that strong tree trunk, get the strong branches, then you can add little branches around it. So maybe we have an office in Milwaukee, maybe it has 600 million, maybe we're not present enough to be automatically on the tip of everybody's tongue when they're looking for a new advisor. Maybe we find a firm that's got 500 million, now we're a player in town without changing the culture of creative planning. So I've never felt we were ready until now.
So, talking about culture and being on the tip of everybody's tongue, you don't speak at conferences,
Right.
you don't do a lot of media, I've never seen or heard you on TV.
Right.
How are you on the tip of everybody's tongue if there are 2 offices in Milwaukee? How do you generate brand recognition far flung away from your home in Kansas?
Yeah. So I think initially my focus was head down, focus on the client, focus on the team, don't get sucked into conferences and things like that. I did a good job of that for a long time. I would decline all interviews that came our way. There's a reporter from RIA Biz here, and Brooke knows how pissed off I was about this, but somebody from RIA Biz called and said, hey, want to do a story? And I just said no, and then they called me back a week later and said, we're doing a story one way or another. It's either your competitors are going to write it or you can be interviewed. And I said, well, I guess I better be interviewed. So that was the first one that we did. And I think it rose our profile a little bit because from then on we were a little more public. But the goal was always to lift up creative planning and to reach out clients. And it was never to, self-promotion doesn't fit in what I was trying to do. What I was trying to do is focus on people and process all the time. And so I get up and I go, what am I doing today? Did I do something to make the place better for clients and better for my employees? I am thinking about that relentlessly every single day. And if I'm doing something that doesn't fit that, I'm asking myself, why am I doing it? And I'm pretty much not going to do it.
Let's talk about corporate culture since you mentioned that. How does a firm develop a corporate culture first? And second, how do they maintain that so that it's a healthy, productive culture? There's a new book coming out on Jim Simons. It's astonishing. Despite these people making 100x what they would make in academia, the rise of he got more than me and the backbiting. How do you keep it healthy and positive?
Well, I think the first thing is it's by example, right? So people are going to look at you and your firm, they're going to look at Josh, and that's going to set the tone, right? You have to have the people at the top have to embody the culture inside and out. I made a mistake one time where I had somebody in a leadership role who was just toxic, and I paid for it dearly. And after that person left, our firm went from doing about $3.5 billion in a year. That year we did $6 billion. That's the impact of one person. So I feel like if you have the right people in that leadership role, that's the first thing, is example. Nobody cares what you say. They're going to watch what you're doing, and that's what they're going to emulate that. The other thing is you can say all the stuff you want, but you have to deliver on it. If you're saying, hey, we're a family and we're a community, you better do things that act like that. 2 weeks ago, we had our picnic. Yesterday, we had our firm-wide meeting. Next week, we're going to the American Royal Barbecue, which will have 1,000 barbecue time. I mean, we are giving everyone in our firm every opportunity to get to know everybody else as well as they can. And so I think setting that tone and being very intentional about what do I want the place to look like, and are the things I'm doing, do they match that or not?
So 95,000 or so clients?
That's 28,000.
28,000 clients, 95,000 accounts.
That's probably right.
How do you keep everything consistent? You have offices in how many states now?
I don't know how many states, but there's 26 offices.
Okay, so
multiple in some states.
So how do you make sure that someone who's a creative planning client in Milwaukee gets the same experience as Kansas, as Florida, as California, as wherever?
So we are religious about process. So the idea what we were thinking about 10, 15 years ago is we have some of the best hospitals in Kansas City. There's some near us in Houston, but people would keep going to Minneapolis when something went wrong. And what happens is an internist meets you on the front floor and sees you, and then they take you to floor 3 for radiology and floor 5 for whatever. They're following you through the whole thing, through that process. And of course, everyone gets different treatment, right? You go through the same process, but you're getting tailored treatment, which meant you were more likely to have the outcome that you wanted. So everywhere that we have an advisor, that client is going to go through the same process, and the investments are going through the same investment committee. There's not one guy can't do one private equity fund somewhere and someone else do another. What's going to be customized is if somebody owns a lot of real estate, we're going to take it out of their portfolio. If somebody has $4 million of Apple stock, we're going to underweight large cap tech. If somebody has certain social beliefs, they don't want gun stocks in their portfolio, we're going to make that happen for them. But they're going to go through the same process. So we had our annual client event the day after our client meeting, which was just Saturday. I'm a little dizzy from it, but we had 3,000 people there. And what do they do on the breaks? They talk to each other. And they're going, what's your experience like? I'm in Milwaukee. What's your experience like? I'm in LA. What's your experience like? I'm in Manhattan. They're saying the same experience.
So you're doing a sort of Berkshire Hathaway-like, get 3,000 clients, not employees, clients, to come to the same place for a conversation
Yes.
with you and the rest of the leadership.
That's right.
What do you discuss with, so you're obviously on a stage, you're having a conversation. What do you say to them? What do you talk about?
So I don't do conferences, I do meetings with clients and employees all the time. But what we do is we give them in the beginning a market update, more a creative planning and why we're doing what we're doing for you update. And then we have speakers on different parts of the portfolio, and then we lighten up. We'll bring in some people that have nothing to do with finance, maybe health, wellness, happiness, because that's what we're very needs-based investors, investors for our clients. I mean, you can get a money manager anywhere, and our process is all about meeting the need. And so those needs are usually goals. We call them goals, but goals is just another word for dreams, right? We're really trying to help our clients accomplish their dreams. I mean, what an incredible profession. That's why I will never, ever retire. At our firm, we've got 27,500 families that worked each family tens of thousands of hours to come up with a pile of money, slide it across the table and go, here, you help me accomplish these dreams, right? So we want to educate our clients. We want to empower our clients. When they go through the correction or the bear market, they don't make the mistake, that we keep them going. And that we know as their needs change, our process is telling us, hey, they now own real estate, or now they've moved to Florida and they should have different kinds of bonds, right? So we want a repetitive process that's going to pull all of that out. And the annual meeting is just one of the many ways that we're teaching them the importance of that process and the way that we invest.
So less than 10% of your assets are in the 401k space?
Yeah,
and
much less, yeah.
Much less, and you've identified this as an area that you think is ripe for growth.
Yeah.
What can you do to grow 401k business? Why has it been such a small percentage after 20 years?
Well, I mean, everything at Creative Planning is about the private client. Okay, so we're focused on the private client, but a lot of private clients are business owners, and they have 401ks, right? So we want to be in the business of helping them. We don't want to say, we're going to help you with your financial plan, we're going to help you with your investments, we're going to help you with your will and your oh, you need a retirement plan, go somewhere else. I mean, we're in the business of helping them accomplish their financial goals. And one of their financial goals is to attract and retain good employees, and you better have good benefits to do that, and the 401k plan is part of that.
Quite interesting. So I won't mention names, but some of your competitors seem to think that there's a massive consolidation coming along, and you either have to join up with a bigger firm or you're going to be steamrolled over. What are your thoughts on the coming wave of consolidation? Can independent RIAs still exist, or are we going to end up being 9 giant entities?
Right. So I think that you hear that at all the conferences,
Yes.
which I don't generally go to, but I've read about. And you basically see the same people over and over saying this, and those people are buying firms, right? So of course they're going to say that.
Wait, the speakers are biased? They're talking their book? How is that possible?
I think there's room for everybody here. Now, I think that you might see an industry change in fees, and you've had some great speakers talk about that here. And the profitability of this business, I think, is certainly going to change.
More fee compression coming?
Yeah, absolutely. But setting that aside as a separate issue, I think that, because people are divided on that. You know, half the people would disagree with me on that. Let's just say I'm wrong about that, and things stay.
Well, hold on a sec.
Yeah.
Show of hands, how many people think fees are going down over the next decade? Raise your hands. How many people think they're going to stay the same or go higher? It's 1 out of 5 people
which
think.
is contrary to everything that you read, and I think speaks to the fact that you've got a younger audience that's a little more savvy to the BS.
Right.
I think that's just the reality of it. I think that the people that have been in the business that are over 40, which tend to be the people that have more assets, I think have a little bit of an arrogance about them, that they're not going to get knocked off their perch, and things are going to change. We have fee compression now. It just shows up differently. People used to charge 1% and throw you in mutual funds. Then they charge you 1% and do ETFs and tax harvesting. Then do 1% and do financial planning. And then do 1% and maybe they give you some legal. I mean, it's coming on the value side, and that's how fee compression starts. And when there's no more
In other words,
value-
you're not lowering fees, you're adding
You're adding
services at the
costs.
same price.
Yeah, you're adding costs, and to compete, you have to do that. What happens when that's done? The other side happens. That's capitalism. That's how it works. So the question to me isn't going to happen. Is it going to happen or not? Is it going to be in 2 years or is it going to be in 15 years? That I don't know the answer to that.
So you wrote a book called
Yep.
The 5 Mistakes Every Investors Make.
Yeah.
The first 3 are pretty straightforward: market timing, active trading, investor behavior. But the next 2 are kind of interesting.
Yeah.
Misunderstanding performance and working with the wrong advisor. How do investors make that mistake, and what can the advisors in this room learn from that?
Well, I think your crowd's probably too sophisticated to learn anything from these answers. I would say that when it comes to misunderstanding performance, your team online does an amazing job of really cutting through all of that and really clarifying things for people. On the latter, I think that the investor space, at creative planning, we still feel like we come to work and that we're raging against the machine. We really feel that way, just like we did 15 years ago. And the machine is Wall Street. But it used to be very clear, you're an independent advisor, you're a fiduciary, you don't have your own products. And then you had JP Morgan and Morgan Stanley and Goldman Sachs and all these firms that have their own products and didn't have to be a fiduciary and all that. Well, now we're in a world where sometimes they're a fiduciary and sometimes they're not. And most independent firms are sometimes a fiduciary and sometimes they're not. And now independent firms have their own products and sometimes they're not a fiduciary. To me, it's gotten very, very cloudy and very difficult for the regular advisor to understand. I saw Michael Kitces did a post. We had like graphs on navigating through the best interest rule. I did not understand it. I mean, he obviously did a great job, but it's so complicated to understand who's doing what, that I think it's a very muddled space and that the burden's on the consumer to figure out are they working with the right guy. I think it's gotten more muddled in the last 15 years, not less.
So you have 25,000 families you're working with,
Yeah.
you have $42 billion. What keeps you up at night? What are you concerned about? I assume it's not the trade war or Brexit.
No.
So what are you worried about?
No. So I would, just to be really frank, I don't worry about anything, right? But I am paranoid about a lot of things. So I think that I have a leadership style where if there's a cloud and it's 3 miles away, I want to go dissipate that cloud, before it winds up over me. So I'm constantly looking at what I think the threats are to the business. And when you look at a business, you just look. If I were setting up shop today and I was going to attack this firm, I want to displant this firm, what would I do? And so I ask myself that question. It's even on my calendar as a quarterly reminder. If I were coming after me, what would I do? And I'm sure you guys probably sit around and consciously or not consciously do that. And we all have vulnerabilities, and it forces you to think in a way of, well, I better tie that thing up, or I better do this a little bit better, or I need to be more aggressive here than I was otherwise. It's a very, very, very competitive space. And I think it's hidden because the market's lifted. So we all feel like we're winning. But if you look at the real growth of the average RIA, it's only a couple % a year. No one's really growing when you take out the market. Some firms are. I know probably quite a few firms in this room are. But it's a very, very competitive place. And I think you got to be really strong going into the next recession.
So I'm glad you brought that up. That was my next question. At some point in the next 1, 3, 5 years,
Yeah.
eventually, 10 years since the last recession, there'll be another recession. What does the industry look like coming out of that? I don't mean the actual economy and the market.
Right.
Hold that aside. What happens to the advisor space during and after the next recession? You said the Great Recession
Right.
was a giant opportunity for you.
We would not be where we are without the Great Recession. I think that was, I don't want to say it was a wonderful event, but for us it was a great opportunity, right? And to really deliver on promises. Because that's what the business is. You make all these promises, and then eventually the client's going to see if you kept them or not. And I think a recession, a bear market, is an amazing opportunity to show value. So to me, while the firm was contracting and we go from losing 1% to 2% or whatever you're doing, we were very proud of our retention then, but we were bringing in 20, 30% more clients than we normally would. If you look at a recession's a great cleansing. I remember in the mortgage business, there were all these mortgage brokers everywhere. Well, the really strong mortgage companies survive and all the others go away. And bull markets hide the firms that aren't running very well. I think if you have a recession, most recessions are mild and it won't matter at all.
Right.
If it's, most of the time we say, oh, by the way, last quarter we had the recession. It's over now, right? That's usually how we figure it out. But if it's a steep or a deep recession, like the tech bubble, 9/11, 08, 09, I think we're going to have an unprecedented bloodbath in this space because people have added all these costs. Technology has become such a significant cost to the typical RIA. Compliance has become a significant cost in RIA. Payroll has become a much more significant cost than it was. And so you have these margins that look healthy, but they're not that healthy in a prolonged market pullback type of environment. I think that day is going to come, and on top of that, you'll have all these over-leveraged firms that their profits, these big mega RIAs where the profits might be in the tens of millions will be negative, and the leverage doesn't work out in that environment. And so I think you're going to see a couple people get caught with their pants down if we get a severe one.
Including the private equity groups leveraged up and buying these firms?
I think there are some people in private equity that are absolutely brilliant. So I've met a few of those people, and they're people that are freaking crazy. I mean, they're just crazy. And they're just some people are good at due diligence and some aren't, and the recession's going to shake it out.
So we're almost out of time. I have one last question for you. You've never brought in outside capital, outside investors.
Yeah.
It's pretty much all been you. Capital is really cheap, and it gives you the ability to add more components that might take you much longer. What are your thoughts on doing a capital round and using that money to fund the next expansion?
So we've been thinking about that for the last 6 to 9 months, and about would we do something like that. I would 100% certainty would never do a control deal. If you look at the 10 largest firms, almost all of them are controlled by private equity, where 50% or more. It would be a very, very tiny minority if we did something like that.
Like a 10% stake?
Yeah, something like that. And it would be only
Bill?
to put only to put enough money in the bank that when the recession comes, we could really jump on that opportunity. And we're still torn on whether we would even do that.
So you're actually thinking that far ahead, that let's get a war chest together, because when the tide goes out, there's going to be a lot of easy pickings.
Abraham Lincoln said, give me 7 hours to chop down a tree, I'm going to spend 6 hours sharpening the axe, right? You want to be planning in advance. And so the idea is whenever that happens, we want to be in a position to seize it. If I knew it was going to happen for 3 years, I wouldn't take any money at all. But if it happens sooner, I'd sure wish I had a war chest.
Fantastic. We are officially out of time, and I don't want to keep everybody from dinner and tonight's event. Let's hear it for Peter Mallouk.